Hello, I'm Kate Stichin, you are watching InstaForex News. There comes a time when the currency interventions do more harm than good. For Switzerland, such moment has come. Switzerland does not need the weak franc any longer. Moreover, the recent data on the inflation testify that the further interventions will be destructive. For the past year, the Swiss National Bank continually was making efforts to stop the falling of the euro against the Swiss franc. For the first below the rate of 1.50 and then below 1.40, and its actions were justified. The economy of Switzerland, which strongly depends on the country's export to Eurozone countries, still tries to revive from the recession, and the central bank strives to provide the competitive ability of the national export. Everything points to the fact that interventions during which the billions of francs were sold for the euro were successful. In the first quarter of the current year, the Swiss export grew by 4.8% and the GDP increased by 2.2% compared to the first quarter of the previous year. The reading turned out to be above the level of 1.7%, which was expected at the market. Last month, the activity in the industrial sector of Switzerland again showed the strong growth. The Purchasing Manager Index advanced to 65.9 against 64.4. The strong data confirm that Switzerland sustained the credit crisis better than its neighbour in Eurozone or even Great Britain. However, it caused the strengthening of the inflationary pressure. Interventions promoted the rise of the national monetary reserves to $145 billion in April. Though the Swiss National Bank was trying to sterilize the purchase of the euro, the monetary base upturned anyway. The Swiss 3-month rates decreased to 11 basis points. This is much lower than 25 basis points set by the Swiss National Bank. If the Swiss National Bank does not want to suffer from the inflationary consequences of the intervention, it has to leave the market right now, having allowed the euro to continue its decline against the franc at least to next target level of 1.37. Of course, taking into account the fears concerning the sovereign debt and the European Central Bank, which still exert pressure on the euro, and also the unsteady recovery of the world's economy, the common European currency most probably will continue to be under the downward pressure. This will force the Swiss National Bank to show more tolerance to the strong franc. It was Forex News provided to you by InstaForex News team. Goodbye.